Shanna, let's picture a young couple excited to buy their first home. They download all the real estate apps. They spend their weekends driving around to open houses, and finally, they find the one.
Oh, yeah, Daniel. That perfect kitchen, the fenced-in yard for the dog. They already see themselves living there. Their dream.
Exactly. They call a lender, ready to make an offer, but after running the numbers, they find out they can only afford about 2/3 of the asking price. They're absolutely crushed. They did the whole process completely backward and wasted so much time and emotional energy.
Yeah, and it's such a common and heartbreaking mistake. And that's why we're going to talk about the first right steps today.
Welcome back to Making Sense of Your Sense. I'm Daniel Hill.
And I'm Shanna Browning. And for many people, buying that home is the biggest financial decision of their lives. It's the American dream. And because of that, the process can feel really overwhelming and very intimidating.
Our goal today is simply to demystify the very beginning of that journey.
And so let's start with the mistake that Daniel just talked about. What is the absolutely non-negotiable first step someone should take if they're just thinking about buying a home?
And before you even look at a single house online, before you ever call a real estate agent, you need to talk to a lender to get what we call a conditional qualification letter. This is the foundation of your home search. Now, we often hear the terms pre-qualification or pre-approval. Let's clarify how First Century Bank handles this.
So it's a really important distinction, right? So here at First Century, we issue what's called a conditional qualification. We don't issue blanket pre-approvals because every loan is unique. So when you come to us, we're going to look at the financial information you provide, your income, your debt, your assets. And based on that snapshot, we're going to provide a letter stating that you appear qualified for a loan of a certain amount, conditional on us verifying that information and the property meeting our standards.
So why is that letter so important to have in your hand before you shop?
Well, there's two reasons to that. First, it gives you a realistic budget. It prevents you from falling in love with that house that just really doesn't fit your financial reality.
It stops that heartbreak.
It does. It does. And so second, in the market, sellers want to know you are serious, right? You want to look for a house, but you're just looking. Well, the sellers are ready to sell. So a conditional qualification letter shows them that you've already spoken to a lender, a local lender, and that we've done an initial review of your ability to pay. So it really gives you, the consumer, your credibility.
And it sounds like it protects not only the buyer, but it also protects the bank. It sets the guardrails so you, as the consumer, don't get in over your head.
That's right. It's not from a guessing game, which is where you started. Now you have a plan.
So once you have that letter and a budget, people naturally start thinking about the monthly payment. We often hear the acronym PITI. Can you break that down and explain why that acronym is so important?
Absolutely. So PITI, again, it's an acronym, but it's your true total housing payment. And understanding that is essential to avoid a really, really big major shock at some point. So what PITI stands for is principal, interest, taxes, and insurance. And so what we're going to do is we're going to take those one by one. And principal and interest are the two parts of that go to the bank.
Yeah, principal is a portion of your payment that actually pays down the amount of the loan you borrowed. In the early years of a loan, that may be a more surprisingly small part of your payment. Interest is the cost of borrowing the money from the bank. So this interest is the cost of having that loan.
Correct.
So P and I, they're not the only parts of the story. What about T and I, Shanna?
So that T and I are crucial and are often underestimated by first-time buyers. So the T stands for your taxes. Your taxes, your property taxes that you owe to your local government. So PITI, principal, interest, taxes. Now we're going to hit the last one for I, which stands for not interest, not on this one. It stands for your insurance. So your homeowner's insurance premium that protects your home from damage. So you have to have insurance as a homeowner. Your bank is going to require that. We're going to require that. So your lender is typically going to collect 1/12 of your estimated annual property tax bill and your annual homeowner's insurance premium along with your mortgage payment each month.
And
so PITI.
They'll hold that money for you.
Correct. So that money is put in a separate account called an escrow account. So then when those big bills come due once or twice a year, the lender, the bank, will pay them for you out of that account. That's a service to you to ensure that the taxes and insurance are always paid, so you don't have to worry about it. But it means your actual monthly payment to the bank can be hundreds of dollars more than just principal and interest, which is sometimes shown on basic online calculators. So you've got to budget for that PITI payment.
So now let's talk a little bit about the types of loans that are available. There's a lot of information online about government-backed loans and secondary market products. How does First Century Bank approach these type of products?
So talking about it from our perspective, we're a little different, and I think that's really kind of a huge advantage for our clients and our customers. So at First Century Bank, we are an in-house lender, which is also known as a portfolio lender. So basically, that means we do not generally offer secondary market products like an FHA or VA loans that are sold off to investors. Instead, when we make a loan, it stays right with us.
That's great. And what does that mean for our clients and customers?
Well, it's local. It's local decision-making. It's local conversations. We aren't just plugging numbers into an algorithm in New York or some big city that spits out yes or no. We're going to look at your whole picture. What's your story? What are you looking for? How can we help? We use common sense underwriting. We know our community and we know our customers. And if you have a unique situation that might not fit that rigid, really closed box of a secondary market loan, we've got the flexibility to look at differently because it's our money that we're lending to you.
And that really is a huge benefit. Does that impact how you would handle a down payment? You know, we often hear myths about needing 20% down.
Sure. Yep. So it does impact it. So while putting 20% down is kind of the gold standard or the practice because it gives you immediate equity and it lowers your payment because you're bringing 20% to us for that loan. We know that's not always possible for everyone. And again, what's the dream? The American dream is to own a home. But because we're an in-house lender, we don't offer those specific 3% down government products you might see advertised nationally. However, we will work closely with you to find a down payment structure that works for you, but also protecting us and making sure your loan is safe and sound.
So the key takeaway here is don't assume you can't buy just because you don't fit a generic mold you saw online. Come and talk to a local lender.
Oh, absolutely. I mean, conversations are important. Knowing your lender, knowing your bank are important because products are different. Not everybody fits into that little box. We focus on the relationship piece. We want to sit down with you, look at your specific financial picture, structure an in-house loan that makes sense for you. We want you to walk away when you thoroughly and through exactly what down payment would be required for the specific home you're looking at.
It really gives that personal touch. And that's what community banking is all about. You're not a number. You're our neighbor.
My goodness, what do we always say? When we are in the communities that we work in and play in, we're investing in that community by investing in you.
Exactly. Investing in our communities.
That's right.
And that makes us who we are.
Yeah, exactly.
Wow, Shanna, this has been an incredibly valuable conversation. And that brings us to this week's actionable tip.
So, action item for this week, we know it's a lot of information, but what we want you to do is to calculate your starter DTI.
There's another acronym.
Oh, those acronyms. So, DTI stands for debt to income, and it's a ratio. It's one of the most important numbers that we as a lender are going to look at, and it can calculate a basic version of it right now.
Here's how. First, you're going to add up all of your monthly debt payments. This includes your car payment, your student loan payment, the minimum payments on any credit cards. Don't include your rent or your utility bills. This is just debts.
That's right. And then you're going to take your gross monthly income. Gross monthly income is the income before any taxes or deductions are taken out. So if you're salaried, just divide your annual salary by 12.
Now, you're going to take your monthly debt payments, divide that number by your gross monthly income, the result of your DTI ratio. That would be that. For example, if you have $1,000 in debt payments and a $5,000 gross monthly income, your DTI is 20%.
And that's really good because lenders want to see a DTI of 43% or lower, including your potential new mortgage payment. So knowing your current DTI gives you a really, really, really powerful snapshot of your financial health. And it shows you how much room you have in your budget to take on a mortgage. I hope this helps us explain to you all what you're looking for to feel more prepared and confident as you're going into house hunting. So what we're going to do next week is dive into the world of digital banking and how to keep your information safe and secure online, like real estate applications.
Absolutely. Don't forget, subscribe to Making Sense of Your Sense wherever you listen, and send us your questions at podcast@fcbtn.com.